Now, the everything bubble was unique for two reasons. One is that when you got a crisis, be it the GFC, be it COVID, policymakers threw liquidity at the system. So there was lots of cash coming in. And secondly, they made the error of slashing interest rates to 0%. Now, when I used to work at Salomon Brothers, the US investment bank, many years ago, the key text that we were schooled on was a book called The History of Interest Rates by Sidney Homer, who was an earlier head of research at Salomon. And that book catalogued 4,000 years of interest rate history. Nowhere in those pages do you ever read about zero interest rates. So the situation that we've come through in the last 15 years have been absolutely unique in human history. And that just underscores what an anomaly we've had. During that period of zero interest rates, debt was termed out. In other words, borrowers who were sitting on large interest rate loans that were upcoming in the next 2 or 3 years decided they'd refinance them, and they'd push that refinancing back into the latter part of this decade, the 2020s. And if you look at the graph, you'll see that the orange line is starting to shoot up, and it tests that broken line threshold sometime in 2026, 27. And that is basically saying that we're moving into a much tighter liquidity framework because more debt has to be refinanced. This chart illustrates that change in the annual debt roll on our estimates. The bite out of the chart in 21, 22, 23 was the response to zero interest rates when debt was termed out to the back end of the decade. The darker red bars are showing our estimates of the amount of debt that's coming back. And this is not the level, this is the change in the level. So these are increments of extra debt that has to be refinanced. If you get a problem in the repo markets, you'll start to see repo spreads blowing out. And this is the repo spread against Fed funds. Now, if this is a barometer, or even if you like a sort of a heart monitor of the system, you'll see that we're starting to get some pretty scary readings coming out. And the point to note is not necessarily the spikes, the scale of them, but the frequency. Because what this is saying is you've got increasing tensions. Now, we understand fully that repo markets tighten at the end of each quarter and they need liquidity. But the point here is that you've got a trend. And what's happened in the last week is you've seen spikes in repo. You've seen the Fed's standing repo facility, which is an emergency financing tranche, being used quite heavily twice. And you've had Jay Powell, the Fed chair, de facto announce on Tuesday that quantitative tightening was ending. And disjoin the dots here. There are problems with liquidity in the system. It's beginning to roll over. And you can see this evidenced in the chart. And that is what we've really got to be very, very alert to. The system needs more liquidity. The bottom line is that simply ending QT is not enough. They're going to have to do a lot more than that. Now, this is the other thing which we need to monitor. And this may be the dog that hasn't barked yet in sort of Sherlock Holmes terms. This is move volatility. It threatens to spike upwards if you get bigger problems in the repo and bond markets. It hasn't yet. It's beginning to lift off a little bit, but I think the authorities are keeping this under a lid, so they're massaging it downwards as best they can. But nonetheless, this is something which needs watching, although I accept it hasn't moved yet. This is the growth of Fed liquidity prospectively, and this is showing what is likely to happen to Fed liquidity over the course of the next 6 months. Now, Fed liquidity was an aggregate we devised back in the late 2010s to try and understand what the Federal Reserve was really doing in terms of liquidity injections. The balance sheet wasn't really good enough as a measure through this QE, QT phases, and you needed a more precise aggregate, which we devised Fed liquidity. Fed liquidity can be estimated by everybody from the weekly 4.1 press release that is delivered by the Federal Reserve at 4:30 Eastern time every Thursday. We show it here. This is the growth rate. We've projected it into 2026. You can see that what is happening prospectively is a significant shortfall in liquidity. In other words, it falls, absolute drops. The previous 2 times that it did that was not very good for markets, and that's what we've got to be alert to. But even if the Federal Reserve stopped its QT policy, that orange line would still decline. It would see probably half the decline that you've got there, but it certainly wouldn't go positive. And that's one of the things to be alert to. What are the risks of this? This is the risks that we need to be also very alert to and up to speed on. This is looking at the movement in excess reserves of US banks. This is based on our calculation of what excess reserves are. We think that the adequate reserve level for US banks is about $3.3 trillion. The Federal Reserve thinks it's about 2.7, so about $500 billion less. We think we're right. We think they're wrong. The markets are telling the Fed it's wrong. The orange line is where excess reserves or deficient reserves sit. So currently, we're looking at a figure of about close to 300 billion below our estimates of adequate. And it lines up exactly with trade fails among primary dealers. Now, if you get an increase in trade fails, I should say that that scale is the right one, and it's shown inverted. If you get an increase in trade fails, you're going to risk higher volatility in the bond markets. The move index moves up, repos spike, and more dealer banks go to the Fed's standing repo facility and try to get cash. And this is really the issue that we've got. Markets are in a slow motion car crash, and we've got to be watchful to see that the Fed does something. Now, what does it mean for risk assets like equities? This chart may give some insight into what's going on. The red line is our estimate of Fed liquidity. So this is the aggregate that we've created from the balance sheet. It's the liquidity generating elements of the balance sheet. This is how it's moved over time since the early 2000s. You can see really what's been going on. It was, difficult to see what was operating pre 2008, but I have to say that most of the driver of markets pre 2008 was private banks through excessive lending or whatever, leveraging. What it is now has really been central banks have been the main source of liquidity. And if you look at the gyrations in the red line, you can see that they broadly line up, certainly with big moves in the S&P, which is shown in orange. Now, the S&P here has been lagged by 25 weeks, okay, so almost half a year. And this is showing the broad alignment between Fed liquidity and the S&P. So if you join the dots here, what you've got to say is the S&P is vulnerable to some pullback based on the fact that the Fed is taking liquidity out. Now, there are 2 ways to go with this thesis. One is to say, oh, whoops, it's an accident, and we're going to be seeing a lot of liquidity coming back into the market soon. I would be hesitant to draw that conclusion because Messrs. Besant, Miran, and Powell, the key figures among US policymakers, are all saying they don't want any more QE because it's an unfair way of stimulating the economy. They want more directed spending. And that's why that's why the Treasury is issuing lots of Treasury bills and focusing that spending on the real economy through defense procurement, stakes in companies, buying essential minerals, this sort of thing. So I think it'll be slow coming. The other thing, which is an even more, or the other route, which is an even more cynical view, is actually they want this by design, because if they create a sell-off of risk assets, it will force everyone back into the Treasury market. And the Treasury market is really the main source of funding, obviously, for government spending. Now, that may be too cynical, but never say never, because policymakers have done that in the past. So that's principally the story of what's happening in the US financial markets.